So if you're asking me whether the banking crisis is over, hell no, no, it's not over. I mean, we're scratching the surface of it. And when Powell just says uh, we have a resilient banking system, puts that in the FOMC statement, it has no role in an FOMC statement. They just show that they're worried about appearances and not fixing the underlying issues.
The banking crisis is not yet over, not by a long shot, says our next guest, Axel Merk, president of Merk Investments. We're going to find out exactly what he means by this, which investments will be safe, which assets will not be safe, and what the Federal Reserve may do next. Axel, welcome to my show, The David Lynn Report.
Thank you. Great to be with you, and congratulations on this new show that you have.
Thank you. Before we get into the banking crisis and your outlook on the economy and markets, let's first debrief what Jerome Powell, Fed Chair Jerome Powell, said yesterday at his press conference following the FOMC meeting. In particular, this statement.
A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data.
Is he right, Axel? Is this a significant change?
That's a good question. I mean, remember, this is the higher for longer Fed. And one of the key criticisms I've had with the entire approach is that higher for longer is not a strategy. Imagine a world where we would focus on what inflation and unemployment is doing, rather than what you just said, the words that Powell is using. It's word dependent, and that can change on a dime. And part of the reason we have this volatility in the market is because we don't quite know. The academics talk about the reaction function, right? What needs to happen? And all we know is inflation is still a little high. Now they're going to start hiking rates, but we don't really know when and why they're going to start lowering rates, and presumably maybe because there's a banking crisis. But one context, just like to throw it in there, is inflation has been coming down a little bit, but as Ben Bernanke, of all people, has rightfully said, once inflation is high, it's no longer linear. So even if inflation comes down for a few months and the Fed says, okay, mission accomplished, well, there's no assurance the mission has been accomplished. And so, yes, I mean, what we know is that they have moved from 75 basis point rate hikes to 50 to 25, and now they're done and they're pausing. And then what, right? We don't quite know that. And that's why the market is just deciding for themselves, well, they kind of have to cut. But it would be more helpful if the Fed were basing its decisions based on some policy rule rather than just the wisdom of 18 people in the room.
Today, as we're speaking on Thursday, a day after the press conference, the S&P 500 is down about 0.7%. The NASDAQ is down slightly. Gold is having a very good day, 1%. And so when you're seeing risk assets go down and perhaps safe haven assets like gold go up, coincidentally, the U.S. dollar is also ticking up. How do you think the market is digesting news from yesterday?
Yeah, just a quite nuance on when we talk about the dollar going up. The dollar index is heavily weighted on the euro. The European Central Bank had a decision today, the euro being the weakest currency today. Indeed, the euro and the Swiss francs, as we're talking, are the only currencies that are down versus the dollar today. All the other ones are up today. And incidentally, both the New Zealand dollar, a high beta currency, and the Japanese yen up today. So the dollar isn't doing as great. It's just the euro is doing poorly. But what do we make of all this? Well, in the context of what I just said, right, the Fed is higher for longer. So the only thing we can be reasonably sure of is that we're going to get a recession. And historically, when you have a mild recession, risk assets, equity markets kind of discount that and look through that. If we have a more severe recession, that's not so good for risk assets. And that tends to be then better for gold, right? Because gold reacts first to the change in monetary policy, or the perception of a change in monetary policy, even if the change doesn't actually happen. And so in an environment where gold does well and equities do poorly, that's confirming the viewpoint that the recession that may be ahead is more severe. Obviously, a day it doesn't make a trend, but we've kind of seen that despite these high rates, precious metals, gold in particular, has been doing quite well, and equities have done rather poorly.
I do want to come back to gold and some other commodities, but to your point about a recession coming, are we sure a recession is coming? Because I don't think the Federal Reserve themselves are sure. The staff projections indicate a mild recession, yet Jerome Powell himself said yesterday that's not his own viewpoint. The staff's projections are independent of the Fed governors, he said. And so he doesn't think we're getting a mild recession. Do you agree?
So first of all, central banks rarely ever predict a recession. Secondly, this is probably the most forecast recession ever because we've been talking about it forever. Usually a recession comes because the wheels are falling off of the horse cart, right? And indeed, we have a banking crisis that might just induce that. If everything goes great, we might get a mild recession. That's certainly not my base case scenario, based on what's happening in the banking sector, based on the yield curve being inverted, based on lots of things happening. We obviously have this oddity that especially on the services side, lots of jobs, there was needed to be a catch up and so forth. But we are certainly setting ourselves up for more severe recession. Now, that said, do I know how it's going to play out? Of course not. When I look at the markets, to me, it's assessment of risks. And when Powell says he thinks that it's going to be a soft landing, first of all, he actually used those words. This time it's going to be different with his analysis. So I thought that was kind of interesting. And because ultimately, when you use the sledgehammer, which is what the Fed has, you cause damage. And the whole point of raising rates is to break things. They just don't want to break the big stuff. And so Powell says that's his personal view. I think what he wants to convey with that is that the Fed has no interest in cutting rates at this stage. That's his way of giving forward guidance in an era when forward guidance is allegedly dead.
So, Axel, I've been following the target rate probabilities of the June Fed meeting, and the markets are pricing in a 91% chance of a pause by June. But what's interesting is that there is a 9% chance now of a 25 basis point cut. Now, this probability has been steadily rising over the last few days. Why do you think the chances of a cut have been rising over this past week?
Yeah, well, first of all, let's give some context here. It's not just the rate hike or cut. It's obviously the broader financial conditions. One of the reasons the Fed doesn't need to hike any further, so they think, is because banks that are impaired, and presumably we'll talk a little bit about more of the banks, but there's a lot of attention on bank balance sheets. Well, banks that are under the microscope for being potentially unsound are not going to extend a lot of credit. And so there is the expectation that financial conditions will tighten further, which is kind of the point of hiking rates. And so the banking system as a whole is kind of adding to the rate hikes. Then we do have some quantitative tightening as well. Why is the market pricing in cuts? Well, it's always, I mean, we always want to have a story to it. My own thought is that they're asleep at the wheel when it comes to the banking crisis. They think they can appease the market with some counterproductive policies. We can talk about why I think it's counterproductive, but by not fixing the underlying issues, which means that this thing is going to blow up in our face and the Fed will be forced to act. Now, some rate cuts are always priced in going forward because the unknown might hit us, and the further we go out, the more that likelihood is. That said, of course, the markets are now pricing in a full percentage point rate hikes and then some, a percentage point and then another about eighth of a point cut by January of next year. So that's quite significant, and that's presumably because the wisdom of the masses suggests that this is going to be more serious than what people are anticipating.
Let's talk about the banking sector now. As we're speaking today on Thursday, PacWest Bancorp is down 50% from its market close last night. And it certainly seems that the Federal Reserve statements last night didn't help. And so what's next for regional banks is my question. How many more collapses are we going to get? Do you think we're getting more consolidation? And is PacWest next to fail, you think?
I don't want to comment on a specific bank, but let me kind of frame the issues that we have and draw your own conclusion from that. And many in the audience are presumably aware of much of that, right? But let's just rephrase this here. we have an environment where banks got a lot of deposits in during COVID. A lot of these banks invested that in long-term treasuries. As interest rates have gone up, the value of these treasuries have gone down. Accounting rules allow you to keep these at cost rather than at market value. It's the only segment in the financial industry where you don't market your securities to market. You do have to disclose it in the small print in your financial statements, and so by all means, these holes have been hiding in plain sight. And so then a few months ago, people started paying attention to this. And indeed, on several banks, these holes are rather significant. Now, obviously, if you just hold your nose and go through this, you might be fine if you hold this to maturity, except in banking, you have this thing that depositors can pull their money. And that's part of the reason why mark to market is so important, because if you did that, when you have withdrawals, you could sell these securities, and the later you sell them, the bigger your losses. But the role of the regulator is not to prevent any bank or anybody preventing them from making a stupid choice. It's somebody's stupid choice shouldn't wreck the system as a whole. And so now what we have is we got what I believe are partially insolvent banks or possibly insolvent banks because they have not managed the interest rate risk, and investors are voting with their feet. And the problem is much broader than that. After 2008, we have taken away market-based measures of the health of banks. So pre-2008, we had an unsecured intrabank funding market. Well, nowadays, the Federal Reserve pays interest on reserves and whatnot. You can just get funding from the Fed. And so healthy market mechanisms are gone. Expanding FDIC insurance is a disincentive for banks to be prudent because you can take higher risk. Ever since FDIC insurance was introduced in the 1930s, banks are taking higher risk, and that's only been exacerbated. So the only checkpoint we have these days is the share price. And when that kind of dam breaks, then all hell breaks loose. And then the other issue we have that we don't talk about much yet is commercial real estate. Right? A lot of these smaller banks have extensive exposure to commercial real estate. And in that segment, put it very simply, costs are up and revenue are down. Revenue are down because office occupancy rates haven't fully recovered, and costs are up because many of these loans are reasonably short term. In the next few years, there's going to be a lot of refinancing, which means that it is no longer economical to hold these buildings. And because these loans are building specific in many cases, well, you just hand the key back to the bank or whoever owns it. And so that's going to blow even bigger holes into the bank balance sheets. And so all of that will not get fixed until you fix the underlying issue, which is capital in the banks, right? Which means they either need to raise capital or they need to be seized and liquidated, and the FDIC insurance needs to kick in. And the reason this doesn't happen is because the Fed has made it worse with its wonderful facility to allow people to get par for the securities they give at the Fed. That converts an acute problem into a chronic one because you still have that hole in the balance sheet. You can just live for another day. And First Republic, I can talk about them because they are no longer around, right? First Republic couldn't raise money. Well, they couldn't, but because just think about it. At the time Silicon Valley Bank went under, First Republic Bank market cap was about $2.5 to $3 billion. Jamie Dimon and his buddies put in $30 billion, but they didn't put it in as equity. They put it in as a deposit, and deposit money is far less powerful as equity would be. But think about it. If they had put in $30 billion in equity versus less than $3 billion in market cap, that means the owners would have been diluted by 90%. Now, of course, they've been diluted by 100%. That's all gone. But if then the Fed comes in and says, hey, we throw you a lifeline, that's a disincentive to get diluted because, oh, I'm limping along. And so these ideas of good intentions, they make the situation worse. So if you're asking me whether the banking crisis is over, hell no. No, it's not over. I mean, we're scratching the surface of it. And when Powell just says, we have a resilient banking system, puts that in the FOMC statement. It has no role in an FOMC statement. They just show that they're worried about appearances and not fixing the underlying issues.
I want to talk about commercial real estate. You brought that up. What is the relationship between commercial real estate and the regional banks? So how exposed are the banks to commercial real estate, and how dependent is commercial real estate on the regional banks for financing?
Well, they're mutually very dependent, right? And maybe to take a step back, and I said that in 2008, it's not what was perceived to be safe or reasonably safe has suddenly become very risky. And so you see that if you look at investment grade commercial real estate trading in the market, it used to trade at very low spreads above treasuries, and now it's trading more in the junk territory. But there's nothing per se wrong with holding a risky investment. But those investments need to be matched with folks who can bear that risk. And so if a hedge fund holds that stuff, that's fine. But if a bank holds that stuff, it's not fine. And so they need to, and as part of prudent risk management, they need to adjust. So those positions need to change hand. But of course, since that's the day of reckoning has been delayed, there are going to be severe losses in some places. And what central banks often try to do is they try to put a Band-Aid on things and saying, okay, if we just let you carry through this, everything is going to be fine. Well, the market isn't dumb, right? They see through this mirage, and especially if you then have institutions based on funding by retail investors or institutional investors putting in cash, well, those guys are not going to wait around. And so you've got to live with reality and embrace reality. And the problem is not the investors that pull the plug out. The problem is that the management is asleep at the wheel, the regulators are asleep at the wheel. And by the way, the problem is that the regulation focuses so much on crossing the T's rather than being principle-based, where you focus on the big picture. And that's all courtesy of Dodd-Frank. But it's of course, it's not the first banking crisis where you fix the wrong problem. Right? It happened in the 1930s, it happened in 2008, and I have no doubt that policymakers will fix it up again. Now, they'll put on plenty of Band-Aids and will probably get through this somehow, but it's rather sad because there would be fixes that are straightforward and much simpler.
What I'm wondering, Axel, is we know that if, back in 2008, when the real estate market started to crash, that had a significant material impact on the bank's books. But can the inverse also work, where if we see collapses in banks, we start to see a direct impact on the real estate market because of bank failures? Does that make sense?
Well, of course, right? I mean, this doesn't take rocket science to figure out, right? There was the Journal an article about a building in San Francisco that 2019 sold for 300 million. It's just being put on the market for 60 million. That might be an extreme case, but the point is that if somebody defaults on a loan, well, the lender is not in the business of managing these buildings, and so they're going to dump those on the market, and they just want to get whatever they can. Now, you can delay that with some things, but ultimately that will trigger a cascade of lower valuations in commercial real estate, which of course then has ripple effects again the other way around. And so now the Fed, Powell has said, oh, he doesn't worry about being too aggressive. He can always cut rates. But those sort of things, monetary policy doesn't act like a light switch. Right? Of course, he could cut rates. That would allow these financial institutions to refinance themselves at a lower rate, and presumably patch up some of the holes that there are on these balance sheets. But keep in mind two things, right? The cascading potential downfall in real estate values is not going to stop from one second to the other one. And at the same time, right, we haven't necessarily fixed the inflation problem. And so it's, people always say we're so much smarter than the 1970s, but the reason why stagflation in the 1970s lasted over a decade is because there's the human factor. There's stupid stuff on the policy side that's done in the meantime.
So when you say that the banking crisis is not over, we talked about real estate. Which other asset classes will be affected through this ripple effect?
Well, my crystal ball is as good as yours. I mean, I alluded to it in the outset. When you have a more severe recession, risk assets more broadly tend to suffer, right? And the bottom in risk assets, and equities most notably, tend to bottom out about halfway, two-thirds through the recession. And and it's a recession based on what the bureaucrats tell us what a recession is. And I know there's been a lot of talk in the blogosphere. Why in the US is it a committee that tells us when a recession is rather than some other thing? Well, my point is anybody who looks at the markets often look at what has happened in past recessions. That's based on those bureaucrats telling us when a recession is. So it's a helpful context in assessing when it comes to markets. Now, I happen to think that equities will suffer in this environment. To put some good news into this, last year diversification really broke down because quote unquote everything fell. I do think diversification will work better this year, much better than last year. Part of the reason, by the way, why diversification didn't work is because of high inflation. One of the most popular strategy had been these risk parity strategies with institutional investors, where you put equal buckets of risk in equities and bonds, often using leverage in the bond portfolio. When inflation is above 3% or so, those risk parity strategies tend to break down in my analysis. And as I just said, right, inflation is not going to be linear. So one of the hallmarks I think that's going to be with us is going to be volatility, because policy isn't very clear. Inflation might be volatile. We have these crises, which means we're going to get interventions. One of the hallmarks of 2008 was that the rules were changed along the way. They're going to do whatever it takes, right? And so I have no doubt that's going to happen as well. So it's very difficult to say what exact asset classes does well. As you're aware, right, we manage over $1 billion in gold and gold mining. And so maybe I'm a little biased that I happen to think that area will do well. But based on my historic analysis, that is indeed a place where you might want to be. But also, I think if the Fed has to cut sharply, bonds could do well. And one area that might do well is something like TIPS, inflation-protected securities. TIPS did rather poorly last year, and people didn't understand why. People don't understand TIPS so well. When you buy inflation-protected securities, you're locking in real yield. And that may sound like a mouthful, but when you have a Federal Reserve that's getting tougher and tougher, they're pushing up real interest rates, which means TIPS can suffer in value just like bonds do. Whereas when you're on the other side of that, then TIPS might be performing well. So I'll just leave it at that on that instrument.
Correct me if I'm wrong, Axel, but doesn't the TIPS follow the inflation expectations?
Yes, but on a real basis, right? You're literally locking in real interest rates when you're buying. You're going to get on a real basis whatever TIPS you're buying over a few years or whatever it is. And so it is impacted by inflation expectations, but once you've locked it in, you will get that real yield. Now, some people, of course, have a problem with how CPI is calculated and whatnot, but if you just got to understand the rules of that game, and that's kind of what you're locking in, and that can be rather attractive returns that you're locking in. And I'm not giving you a specific investment recommendation.
For sure. Let's talk about your inflation expectations, and then we can link that back to gold. I've been hearing conflicting arguments. One is that as a recession nears, we may get disinflation, if not outright deflation. So that's one side of the picture. The other argument is that the Federal Reserve may reignite quantitative easing to shore up this banking issue, and that will increase the money supply, which would boost inflation. Where are you on this spectrum? What do you think is going to happen to inflation?
I think all of this is correct. If you're not confused, you're not paying attention. Just like in 2008, if the market forces were allowed to play out, there would have been a deflationary bust, right? And if the banking crisis isn't addressed, there's going to be a deflationary push. But they will address it somehow, and they'll do it inefficiently, and that's going to be inflationary. I'm in the volatility view, that once you have high inflation, it doesn't just come back down linearly. Even if it comes down, it can pop right back up. And the context here is this inflationary period was induced by both, most notably, a supply shock. That was the origin, right? There was a supply shock, and I call it stagflation. Is a supply shock followed by policy mistakes, right? When you try to fix a supply shock by writing checks, Europe, they don't have enough heating for the winter, so they write checks for people. Well, writing checks doesn't increase the heating supply, right? And so wherever you look, politicians, the right thing to do politically tends to be the wrong thing to do economically. Because saying, hey, yeah, well, heating is so expensive, yeah, you should lower the heating in your house, right? That's not going to get you reelected. And so similarly, we're probably going to have a recession. That's probably going to be a downward force on inflation, but it doesn't mean inflation has been beaten. And so it's going to show its ugly head again somewhere. It's going to be volatile. And if we don't have a Federal Reserve that's rules-based, but it's based on a committee, they'll be late with whatever they'll do, and that will create jerky moves, right? And then we have a banking crisis that's not properly addressed. And so all of that creates uncertainty, volatility, and erodes confidence, right? And one of the things, I mean, we talked about gold, we talked about the dollar. We appear to have seen the peak in the dollar last fall. That happened to coincide with the Federal Reserve kind of pivoting from 75 basis points rate hikes to 50 and then 25. The dollar hasn't properly rallied when there's been these crises flare up. And you got to wonder why that is. And I think there are a bunch of reasons, but mostly that the market thinks that all of this will be addressed through reflationary efforts. Whether they'll succeed is another question. But I do think inflation is going to be volatile going forward.
So let's comment on the dollar now. So the dollar is up slightly on the day, the DXY, and you commented before as to why, which is because that the euro is slightly weaker today. Let's comment on this cross pair, the euro versus the dollar. What's going to happen to this currency exchange over the course of the year, given that the Federal Reserve, some say, is near the end of its rate hike cycle, while the ECB is still not done theirs?
I think it's mostly driven by the trajectory. And so a key reason why the dollar had peaked out last fall is because the Federal Reserve indicated kind of they're done with the peak hawkishness, the second derivative, so to speak. They don't need to cut rates, but the second derivative in rate hikes was changing. And actually, we had that second derivative change in the Eurozone today because they quote unquote only raised 25 basis points rather than 50. And so with 9 months or so delay, the Federal Reserve is following that path, but it's because the European Central Bank is behind in that cycle that the euro is benefiting. The other part of that is the issues in the banking segment are more severe in the US. Now, that said, obviously Europe also has commercial real estate. There's a little bit less leverage used in commercial real estate in Europe. There are some players active in that space that are under pressure, but the way that the banking system in Europe is kept afloat, so to speak, is it's easier to keep a zombie banking system even afloat. We saw that obviously during the Eurozone debt crisis, whereas in the US, just through the history, the entire banking system has quote unquote always been a mess. We have these small regional banks that are not well diversified, that are clinging onto FDIC insurance, that are completely overwhelmed with the red tape that's thrown at them. And so they're limping along, and now you throw a crisis on top of that. And so that can potentially accelerate a consolidation. We obviously saw JP Morgan get even bigger in this context. I have no doubt that these big guys are going to get substantially bigger by the time all of this is said and done, because the entire banking system in the US is really a political gamble that's been misconstrued for 200 years. And this is yet another episode in how the entire patchwork of banks in the US is not exactly working out well.
So let's link this back to gold finally. As a gold investor, then, you're looking at both inflation and the US dollar. Can you describe the relationship between these three variables very briefly before we move on to your outlook. Gold rallied to $2,000 this year. It was interesting because inflation on paper, the CPI print, has continued to fall. And so one could argue that gold wasn't hedging against inflation this year because inflation was coming down, not up. So why was gold rising this year in light of lower inflation? And let's link that back to the dollar as well.
Sure. Well, very briefly, we see three types of gold investors. The investor concerned about the purchasing power of the dollar, the inflation investor, so to speak, the investor who likes gold because of its diversification benefits, and the investor who likes gold as a speculative investment. So whenever there's a move, they jump on. The speculative investor kind of moved on to the meme stocks, crypto space and whatnot. So there's less of that, but I've no doubt they can come back when there's a big move in one direction or the other. The diversification investor has really come back this year. Gold in the long run has a zero correlation to equities. It's often positive, often negative, but in the long run, it's zero. Those investors are embracing gold more. And then on the inflation side, the correlation that gold has is to real interest rates, longer-term real interest rates. Any investor is forward-looking, so they don't care so much about the inflation today. And then people say, well, again, right, long-term, nobody knows what rates are in 5 years or 10 years from now. That's correct. But the perception, they reflect the perception of how well a central bank can manage inflation going forward. And we had reached, I mentioned, peak hawkishness last year. And ever since we've reached that, gold has done quite well. And as we're talking, looking at my screen, 10-year real rates are about 116% on an annualized basis, and they were in the high ones just a few months ago. And so that sort of environment provides a tailwind. And so people are always confused, oh, inflation is higher down, why isn't gold doing well? Well, it's because gold, this barbaric relic, doesn't pay any interest, competes well with cash when cash in real terms is depreciating. And so if the market perceives they get compensated for holding cash, then gold doesn't do well. Now, of course, the environment we're in is we have too much debt out there. We fix every problem with printing money. And so the gold investor says, hey, yeah, well, in the long run, I should be doing quite okay with gold. And we are more in that camp.
So could you say that the gold market is anticipating lower interest rates? Is that why it's going up?
Well, of course. I mean, that's we just talked about, right? The market is anticipating rate cuts. The market is anticipating that the Fed will be less hawkish because they can't stay where they are. And so that's the market that perceives that we've gone way past the peak hawkishness. The actual rates don't matter so much. What matters is what the perception is going forward. And that's why I also mentioned earlier, right? You asked me, well, how likely is a recession? Or will there be a recession? And my answer is, the question is not whether there will be a recession. The question is, what is the risk of a recession? And because the moment people perceive things as a risk, they should, and many will, take it into account in their portfolio allocation. And so that's what the gold investor does, right? The gold investor says, well, there's a mess out there. Fed policy will have to be easier, and that should be good for the price of gold. And then it becomes a self-fulfilling prophecy.
Bottom line is you think that the risks are in gold's favor this year, which is to say that there are many economic and perhaps geopolitical factors that may push the gold price even beyond $2,000. Can I make that statement?
Well, it is currently above two. The risk to that outlook that you just give is that if policymakers come to the senses, right? And the question is how likely is that going to be? One of the things that I got some heat for in the financial crisis is when I said very simply, the best short-term policy is a good long-term policy. And I actually believe that, right? If in order to fix banking or in order to fix deficits in the US, right? Having a sound plan on how you will move forward, that's how you help get real interest rates up, right? If you find a sound way of allowing people to invest in the long run. See, one of the side effects, just to give an example of having a mess both in the banking system and in Congress as well on sustainable finances, people will not commit capital to as long-term projects as they otherwise would, because they know that they will be cheated somehow, either through higher taxes, through higher inflation, or some other way so that the government can limp along and kick the can down the road. And so in that sort of environment, real rates are going to be lower. And so again, if you believe our lovely politicians will come to their senses and institute good policies, then gold may well suffer. And it's part of the reason why gold, of course, is not very popular as an investment in quote unquote mainstream.
Very good. All right, Axel, I appreciate your breakdown of the markets today. Thank you very much for your thorough analysis, and look forward to speaking with you next time. Thank you very much.
Yeah, no, my pleasure. And then come follow me on Twitter at Axel Merk, or come to my website, merkinvestments.com, if you want to learn more about what we do. Thanks, Ed.
Oh, yes, of course. And do you have a newsletter as well? And where can people read about your work?
Yes, so Twitter is really my unfiltered view. I'm regulated because I work in the industry. There, I'm the freest to talk about products there. But follow me on Twitter. And then, yes, on merkinvestments.com, we do have a free newsletter. Sign up for that and then look around what else we do, especially also in the gold mining and also speculation space. Yeah.
And your fund, Merk Investments, is it open to all investors or accredited investors only?
Those are public funds. We have an exchange. We have two exchange traded products. We have a closed-end fund, and that's the sort of thing we can talk about in public, and that's on the website.
Okay, excellent. Thank you very much, and thank you for watching the David Lynn Report. Stay tuned for more, and don't forget to subscribe.